Hi, welcome to Market in a Minute. Do you know what January 20th is? Yeah, you're probably thinking it's the Trump inauguration. No, 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 no. It's the national championship game for college football. Go Buckeyes! Sorry about that, but please root for the Buckeyes. I think we're set up to have a similar risk scenario as we did in 1987. If inflation continues, it doesn't come down, continues to go up a little bit, and bond yields go up, say in that 550 range, we're at 480 on the 10-year Treasury. We're set up to have a similar type of event. I'm going to show you specifically on a chart where the break point is for the stock market via the bond market. So the stock market is concerned about inflation and bond yields, but we also have earnings reports coming out. So it's our belief if that earnings don't on these high flyers don't beat by a lot, then I think the stocks are going down. If they report just in line, the stocks are going down. And if they miss, the stocks are getting crushed. So it's going to be a tough earnings report season. Now, I think we're in a crocodile type of market. You wonder, okay, what does that mean? It's a market where the stock market's gone up and bonds have gone down. So you know what happens when you stick your hand in a crocodile's mouth? It gets bit off, right? So if you look at this chart here, the stock market's gone up about 10% since September. The bond market's gone down about 9% since September. So yields have gone up on bonds. Bonds prices have gone down. Stock prices have gone up. Generally, under this scenario, we would have thought that the stock market would have been about flat, maybe down some in this environment. So there's a couple different ways to value the stock market. We like to look at it, the 10-year Treasury, put a risk premium on that. The 10-year Treasury yield, it's got to be something that the market believes in. We think the market's in that 4% on the low end, 6% on the high end, maybe. So it's currently 4.8, good enough. Add a 1% risk premium to that. That's kind of low. You get 5.8. You invert 5.8%, you get a 17 multiple in the stock market, and we're currently at 21.5. Granted, the Mag 7 distort that. So maybe it's not down as that much, but it's probably still down about 10%. Now, this is an old model that the Federal Reserve used. It's called the Fed model. It's basically you take the earnings yield of the stock market, divide that by the 10-year Treasury yield, and you get a percentage, right? So this is a graph of that. So where we are currently is we're about equal. Earnings yields on stocks versus the yield on 10-year Treasury is about the same. So we're kind of approaching that overvaluation level on a methodology that's probably too aggressive. Now, if you look at the different periods of time, 1987, it got to about a 30% premium. So the earnings yield divided by the 10-year Treasury yield got to about a 30% premium. And then you saw that, so that was a correction or bear market because of valuation. Now in 2000 through 2022, we had a similar valuation problem or higher. You had a valuation problem, but you also had an economic problem. So earnings went down as well. So that was a massive bear market. I think we're more set up to have one of these more gentler bear markets than both the earnings and the valuation coming down. I think you're going to have a little bit of earnings, not much decline in terms of the expectation. But if we get inflation to continue, then you also have a valuation problem. You have a valuation problem for the markets. And from where we are currently, if it goes up to around this level, so what is that level? It's roughly 5.5% or higher. So 5.5 to 6% on a 10-year Treasury. We're at 4.8. So if you get bad inflation numbers, you're going to see that yield go up. And if the market gets spooked about Trump's policies, if it gets spooked about tariffs causing inflation, oil prices going up, and we're seeing that. So we talked about that. Oil prices going up, because of Iran. Iran's toast, basically. But oil prices going up, that will cause inflation to kick in again and the 10-year Treasury to yield to go higher. So so CPI is on Wednesday. That's important. Earnings kicking off this week. That's important. So we have two kind of big events happening this week. So we see a lot of stocks that we like currently. So it's a stock market that has problems, but beneath the stock market, there's a lot of really interesting stocks. We talked about the rotation factor last week. We think that it's starting to happen. We have over 40 stocks that we think are viable. That's a lot for us. So we have about 40 stocks that we like, and only six are out of the technology sector that we think that are interesting. Now the technicals. So again, we talked about this last week, and it's continued. So the rollover has continued more. We're down to about on the S&P 500, the 100-day moving average. So the yellow line is the 100-day moving average. We broke through the 50. We really don't like when the market breaks the 50-day moving average. And then obviously it's gone through the 20 much before that. So here's the 200-day moving average down about 55.75 on the S&P. We think that's an important level. That's still about 20.5 times earnings. That's still on the high end. So we were thinking more like 19 times earnings is more appropriate. But we think that the market finds a bottom in this area, at least temporarily, provided that the CPI is higher than expected on Wednesday, or as expected on Wednesday is still not going to be great. The run rate's going to be about 3.6%. Inflation is going to come out probably around 0.3%. So roughly a 3.6% annualized rate of inflation, which is not good. So we need to see inflation, below 3% or lower. So the Russell 2000, it's broken all sorts of moving averages. It's down here close to a support level, and the 200-day is not far off. So this is a sector that we like. We'd like to see it break through that area, and then we'd start to get more aggressive on it. We have a small position in the Russell 2000 currently. We'd like to see it kind of on the way up when interest rates are starting to drop. So there's a lot to happen here for us to get really excited about the Russell 2000. But we think that is where the money is to be made in 2025. Now, energy stocks. So we talked about Iran. Iran's not going to sell any oil once Trump is in office. Anybody that wants to assassinate Trump, I don't think they're going to be treated very well. So we think Iran has problems. Biden's already going after, before he leaves, putting more sanctions on Russia. If Russia doesn't cooperate with Trump, we think that they're going to have their oil to have sanctions against it. But a new name's popped up recently for us, Venezuela. It's the troublemaker in South America. We think that their number might be up as well. So all this is really good for energy companies in the United States, but it's not good for oil prices in the short term. Therefore, it's not good for inflation. So if you take a look at energy, we got this buying opportunity here. That was a good buying opportunity back in September. We got another one back in December, and that's kind of worked out very nicely. So it comes down and gets these real big oversold conditions and then pops. So oil is a trading group. Perhaps it's more than just a trade this time. Maybe there's some legs to it for 2025. Now, the other three areas of the market that we like because we think they're way oversold. Consumer staples, almost the entire um, food sector, almost the entire food sector of the markets, to us, look really attractive. So the staples in general look really compelling. Kimberly Clark looks good as well. So we've got 9 stocks in that sector that we think are viable. We're not going to buy all 9, but we think that this sector is kind of at a bottom. Now, using technicals on sectors versus the market itself, we don't think breaking the 200-day is all that is especially negative for a sector of the market because they tend to revert back to the mean very quickly. So we kind of like it that it's broke the 200-day and is oversold here. Healthcare, same way. It's uh, it's in a little mini downtrend starting in September. It's corrected quite a bit. It's starting to lift. We think that there's a lot of M&A in this sector to occur. Hopefully, they catch some of our really good small cap biotechnology stocks that we own. But we also, it's interesting. J&J went up on an acquisition they made. Went up a little bit on an acquisition they made. So J&J is changing. That's one that you can buy and hold. But J&J is really becoming a faster growing company as they divested their consumer products businesses a couple years ago. The material group, it's busted. It's in a correction, a big correction. So there's some really compelling stocks in this sector as well. Dow Chemical is our favorite there. It's got close to 7% yield, around 7% yield. Plus, they go back to if they go to a the normalized earnings. So Dow Chemical looks really attractive to us at a 7% yield. And if they go to a 7, they go back to a normalized earnings for that company, then you can see a double in the stock price, say over a 2 to 3 year period. Um, that gets you a really nice rate of return in a stock that's good quality and really beat up like the group in general is. Keep in mind, China is screwed. They've had so many problems. Um, they've got they have issues in the real estate sector that are just insurmountable. So we see that China's going to have to do a gigantic stimulus program, a very, very large stimulus program to get their economy back growing again, get liquidity back in their economy. That'll help the material stocks in a big way. So we think China does this year. If not, there's going to be a continued drag, but we think they do that this year. So just if you like what we do, come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. It has more detail on it, a lot more stats, and we'll send that to you every week. But thank you, and then root for the Buckeyes.